This is really, I don't know, I just feel like so excited because it's good for people like us, like young accountants, especially if you're thinking about maybe 2, 3 years from now, running your own CPA firm and stuff. So it's good to learn from, because you're not gonna get this information when you're working in public account. Nobody will teach you.
Yeah.
All they teach, bam, 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 do this, prepare this, prepare this. So it's really, I mean, it's really great. So I'm so excited. Yeah.
Yeah. Well, good. It looks like Sammy has joined.
Yes, hello.
Hey, Sammy, how are you?
I'm good. How are you?
Great. Great.
Hi, Sammy. Nice to meet you.
Nice to meet you.
Yeah.
Yeah, Jamo and Sammy. We were just talking a little bit. Jamo's telling me he's with Baker Tilly. He used to be with Ernst and Young, and he was primarily audit over there, and now he's primarily tax and looking to be a sponge and learn what he can. Sammy, why don't you tell
Yeah.
me a little bit about your business?
Sure. I was at PwC for 8 years in the private company tax group out of Detroit, where I still live outside of Detroit. I left in fall of 21, and have since started my own company. Still doing a lot of tax, but over the summer and non-tax season, trying to um, expand more into the accounting and advisory space. And I've got 3 small business, kind of Schedule C and S corp clients right now, but I'd like to build up that practice to be a little more consistent.
Right. Okay. Good. All right. Jamo, do you have anything you wanted to add about like where you are and what you'd like to get from this community?
No, not anymore. I'm just trying to learn, trying to get the experience. So
Okay.
yeah.
Yeah, as far as today goes, at least, Sammy's probably the one that we would kind of focus a little bit more on just because he's in the what I think is the prime position for taking advantage of, where this situation is in the public accounting field as well as the national debt and, tax changes that are basically inevitable. And so that, we'll see where he fits that in. I can see you, Jamo, being in Sammy's position not too far down the road. So I'm sure it'll be helpful for all of us to kind of just kick things around. Sammy, what attracted you to this and what would you like to gain from it, investing the time that you are?
Not to tell too long of a story, but just coming out of tax season and planning ahead for the summer, I was looking at my clients and my book of business, and I had been mostly working on my own over the last couple of years, and I realized that I need to be more involved in the broader accounting community. So I started following more people on social media and LinkedIn, and I think that's probably how I found you, David. And so I just was like, I need someone else who's in a similar position to me, maybe a little bit further advanced, to network with, to learn from, to bounce ideas off of, to broaden my own perspective, because we all know tax is so broad, and my experience has been, I said earlier, it was a variety and it was broad, but it was still limited to the kind of clients that a big firm would have, or now like extremely small clients. And it's always good to have a different perspective, because we all know it's more of an art than science in a lot of cases. So
Right.
just wanted to broaden my base and learn what I don't know, and find out more about things that even I don't know that I don't know.
Right. Okay. Very good. That's exactly the kind of person I'd like to be able to help. Was there myself and have come a long way. And as I slow down a little bit, I'm not dealing with clients directly anymore. I'm not selling products anymore, but I do see that CPAs can and should be a little more proactive in doing financial planning, tax planning for their clients. And I see way too many people kind of falling through the cracks that they get bad advice or bad products because they're just dealing with salespeople and their tax advisors aren't involved in the process. So I think there's an easy way to bring the parties all together. And that's what I hope to do with people. And I have different levels that I can help at. And, like I said in one of my presentations, I don't know if you've seen the crawl, walk, run, fly thing.
I haven't yet.
Okay. I'll have that to pull up here, but basically it's like different levels, how far do you want to take it? I was talking with a CPA I've known for 25 years just last week, and his firm is now offering asset management. They're doing financial planning, something that I had done for his clients, and he had done tax work for my clients and so forth. And now they're kind of getting into that field, and they're a fee only, and they want to try to, do financial planning, number crunching and asset management. And they're going to make some money on the asset management side where they'll charge a fee, a 1% fee or something like that. And they'll use third-party money managers to do the actual work and stuff. And I asked him about the insurance side. He said, no, we're not going to touch the insurance. So there's a lot of people that get afraid of the insurance part. So even in a case like that, I could hook him up with somebody that I know and trust that understands insurance better than the average insurance agent or sales rep. And, you're doing a better job in the end for the client. And I think the CPAs ought to be involved in that and charge for that. So in my ideal world, a CPA would talk to a client and get them excited, get them disturbed a little bit about what's bound to happen in the future. We'll see that the federal government is broke. The political gridlock is preventing them from doing anything to address the financial woes of the country. And we're adding $1 million to our debt balance every 40 seconds or so. So it's kind of crazy. At 35 trillion of debt, it's growing rapidly, and we got to reverse that. So you can't just cut the biggest expenses, which are Social Security and Medicare, because you've got 10,000 baby boomers every day enrolling in those programs. So they're not going to be happy about cutting those costs. And between the national defense and the interest on the debt, and then Social Security and Medicare, that accounts for like 92 cents of every dollar that we raise in taxes. So you can't really do much with the other 8 cents and make a big dent, right? So the expenditures are kind of stuck in between a rock and a hard place. And the only other thing you can do is raise taxes. And in fact, after World War II, that's what we did. We raised tax rates in 1945 and kept them high for 40 years. Between 45 and 85, tax rates were basically double where they are today. So if you just look in that crystal ball, everybody should be able to see that, the math doesn't work. Former Controller General of the United States, David Walker, said, we've got a 4-letter problem in America, and it's math. It just doesn't work. And he was Controller General for like 8 or 10 years, and he kept sending the annual report to Congress saying that this is unsustainable. As a nation, we have to address this, and they never did. So eventually, there's not going to be any place to turn, and we're going to run out of the ability to print more money. And that's basically all we're doing, is we're printing more money. But the problem with that is, you just put more money in circulation and it causes inflation. There's more dollars chasing the goods and services, and the prices go up. Inflation hurts everybody. So you got to put an end to that. And the first defense when you're facing inflation is to raise interest rates. And that's going to kick you in the butt because we got 35 trillion in debt that has to be refinanced. So instead of refinancing it at 1% like we have in the past, the average of the past 15 years, we're going to have to refinance it at 5 and 6 and 7%, which just, it's a spiraling out of control problem. So the reality is we got to consider not, 22 and 24% tax brackets and a high of 37. We got to look back and see what it was in the past and say, what should we be doing now to deal with that? Does that make sense? Were you able to watch the first 2 sessions that I recorded for this?
Unfortunately, I wasn't. I haven't pulled up, and I was going to watch them, but haven't I haven't gotten them yet today. I'm sorry.
That's the biggest problem I face is just getting people to spend the time, because I think if you recognize all these facts and then you turn around and you talk to your clients and say, look, we have to talk about some serious tax planning. And I think if they watch some of the videos I've prepared, if even you want to re-record some of the videos so that it's in your own words and your own name, that's going to add a lot of credibility. And I think they're going to come back and say, geez, Sammy, thanks for telling me this. I never thought about this. I know you're kind of in tune with this kind of thing and you're ahead of the pack. What do we do? I mean, let's talk. And you come in and, you say, here's what we want to do. And we're going to create 5 or 6 different tax-free income sources for the future. So when the crap hits the fan, if you will, that you've got a lot of tax-free income sources that you can tap, and most of your income can be coming in without going on your tax return. So let's work on setting that up over the next 6 to 10 years, because it'll probably take that long for Congress to get their act together and finally face the music. We have some time on our hands and we have low tax brackets. So we have to kind of change the thinking and say, we don't want to just get your tax bill as low as possible and just be in compliance with reporting. We want to actually take advantage of today's tax rates and do some conversions and set up some other income streams that can come back tax-free. And, when it finally does hit and you move from a 22% tax bracket to a 48% tax bracket, it's going to be okay because most of your income can be coming in tax-free. So I think people will love that. And, to the extent that you need to lean on somebody else to use the right products like investments and so forth, I can team you up with good people that are of the same thinking. And you can even get licensed and share in that revenues and do it as a team, but you can be charging higher fees and your clients will be well engaged and they'll be happy because, we know you'll save them millions of dollars over their lifetime. So this is really futuristic tax planning, not just tax planning by December 31st, that kind of thing. So it's really kind of important to grasp some of the videos that I put together. I have a whole course with 5-minute videos, 4 on taxes, 4 on the national debt, 4 on Roth opportunities, and 4 on insurance, where insurance comes into play. And it's not always going to come into play, but it is a viable way to get tax-free income, just like a Roth. And it's an important player in this whole process because people are generally underinsured, and they also need to have as many different sources of tax-free income as they can to diversify. If they go to increase the taxes in the future, they may take some breaks away. They may say, look, we meant well when we set up these Roth accounts, but we're broke. We're now going to have to tax the earnings on the Roth. They could do that. They could also say we're going to tax the earnings on your life insurance and you can't take that out tax-free. So you just have to diversify. And a lot of people are to the point where they can't really do much more in Roth accounts. There's some situations where there's only so much they can do. And life insurance becomes another alternative that you can use to help them create more tax-free income. And by the way, I've been in insurance for like 35 years. I've worked with insurance policies. A lot of it is the same as everybody else's. There's basically 3 really good insurance products on the market that have been designed to eliminate some of the things that we hate about life insurance. Some policies are designed to actually do very well and charge very little, and they've got guarantees in them. They're basically put together to take advantage of the tax rules and the tax favored treatment that life insurance gets. And it really only works if it's overfunded. So you get the smallest policy you can for the amount of money you want to set aside. So that could be, $1,000 a year. It can be $100,000 a year. And it all depends on the client's situation. But I will show you in some of these sessions and in some of my videos why it works in some cases to be even better than a Roth account. And a lot of people just don't understand it. They want to wash their hands of it right away. But in the right situation, it can be a great addition to diversified planning. So I don't want you to think this is some kind of a trick to just sell insurance products. Again, I'm not going to be selling them. You can refer that out. You can refer it to somebody that I can connect you with. You can get licensed and participate in those revenues or not. But you can charge your clients more and you can protect them from the bad guys, if you will. So that's kind of the goal as we proceed through this thing. So I want you to have a number of sessions with us to talk about this and get ideas from other people. Unfortunately, people aren't going to be able to make every session, but they'll be recorded and we'll share them. And I think it'll get more and more people interested in joining us, and we can go from there. Questions or thoughts on all
that? I do have some thoughts. I'm not really questions. I'm just trying to think of the best way to order these. I guess my first thought is that this is great. I really appreciate it. I've kind of been around these issues in my personal financial life, where I do have a life insurance policy that I was sold when I was 23, 24, just starting at work. And so it's been 10 years I've been paying into it. Despite, being a CPA and educated, I still don't think I truly kind of intuitively understand what it's doing. So I basically just have faith that it is appropriate for my situation. I think it is. I also have my Roth IRA. It's not something that I've really studied very closely, and I don't feel confident intuitively speaking to it in front of a client. So I think it'd be really helpful to talk through and kind of practice how I analyze different scenarios and express what I know confidently in front of my clients. And, depending on their different situations, saying, you have a lot of wealth, but not a lot of income right now. And do a big Roth conversion while your income's low, or you're making a lot now. This is what you should invest in, and just feel more natural on talking through. Because right now, and what I've done over the last couple of years is basically referred that all out to existing asset managers or financial advisors and offered to work with them, but to support and stay involved. And actually, a lot of my clients have been referred from my own advisor network, just people that I know. But I do feel like I could be providing more value and getting paid more by being better at that process.
Great. Good to hear that, because I think you're like 95% of CPAs, they would do the same way. It's hard enough to be adequate or expert as a tax preparer, but that results in referring business away. And the advisors are making more money than the tax preparers. And the tax preparers are afraid of stuff that they don't understand. But the reality is, that leaves you in the jungle of tax preparers that have to do all this work by April 15th. And, we hate it. And, there's pressure that everybody shops it around and stuff, and they're not giving you the value that you deserve. So I think if you just step into this zone and you're with somebody that you can trust as the advisors that you're going to work with, then, and with my help looking over their shoulders and so forth and making sure that you're not getting, shafted and your client's not getting shafted, then you're going to learn a lot and you're going to love that. I mean, I was kind of thrown into that because I wanted to become a CFP. And at the time that I was doing it, there were very few CPA CFPs in the country. And I was one of the first. And I had to get onto the product side in order to understand the business, so I got out there and I started working with products and with other advisors, and I would put the plans together and they would sell the, investments and insurance and stuff, and we would share that. And it didn't take long for me to figure out what they were recommending and where it might not even be their best thing, so I just kind of loved learning the new stuff, so you learn and you enjoy it and you're doing a better job for your client. If they have to get past you for your client to buy something, then you're going to learn and you're going to prevent them from selling something that they shouldn't be selling, right?
Mhm.
And that at the end of the day, or the end of the next 3, 4, 5 years, is going to put you in a much more valuable position. You can be charging a lot more. You can be taking some of the comp that the advisor's making. There's all kinds of different levels that you can, find your comfort zone at. In the end, you got advisors that are learning from tax professionals. You got tax professionals that are learning from advisors, and you got happier, more successful clients that are making fewer mistakes. And we're all getting ahead of the game and divorcing the IRS. If you could make all of your income tax free in retirement, everything is in Roth or other things that are tax free, then you can be making $500,000 a year and not pay any taxes. I have a video out there, Divorce the IRS Amicably, of course. It basically says that the IRS is like a bad marriage. They're a partner to us, and they get to decide how much of the income they want, right? They get to change the rules. I mean, the IRS doesn't exactly, but Congress does, and the IRS enforces it. But they basically can take whatever they want. And those numbers were different in prior decades when we had to pay the debt down. So, let's get to where we have, 4 or 5 different tax-free income sources. And maybe they've jacked the rates up for a 3-year window, but that 3-year window, you just pull money out of your Roth and you're not paying the exorbitant taxes. And then taxes go back down, and then you take your taxable income out. So you want to be in control. And we aren't in control at all. Generally we're just in compliance. We're not in control. So that's the whole goal here. If you had the number of clients you had today and you were charging them all double what you're charging them now, would you be happier? You said you're not at full capacity, but then that means you don't have to work 60-hour weeks all the time and stuff. So I think it's a real win-win-win situation. Everybody can benefit from it if we put it together right, and everybody just learns along the way, and you feel more excited and comfortable about what you're doing.
Yeah, I got a little bit of experience when it comes to that. So I'm a little bit exposed to the financial industry, right? So I feel like, if you're studying for the CPA now, you know about the IRC code 7702. I think it is there for a reason. But now, most people don't understand, including CPAs, right? We study it, we just know that, okay, the death benefit of the insurance is not taxable and stuff like just where we end. So I feel like as a CPA, especially if you are running your own CPA firm, like you can add more value to your client, like providing what you say. Because there are so many sales insurance out there. All they do is just sell, right? They even talk about taxes, which they don't even understand, but they just trying to get the client, or is tax advantage, or it's not taxable, it's zero booking and stuff like that. That's all they care. So I feel like you as a CPA running your own CPA firm, if you're able to educate your clients on that aspect of the financial industry, I think it adds more value to what you'll be doing. And like you said, you also then get paid more at the end of the day rather than just crunching numbers and stuff like that. Because the financial industry is really broad. So for me, I'm not yet a CPA. Hopefully this year I'm gonna finish my exam, but I'm a Lansing Life in I got my life insurance. I feel like it's very important. So I don't have to wait somebody to tell me, to do this or do that. I feel like it's important. So if I can learn the financial industry together with my CPA, the taxes and stuff, I just feel like I'll be at an advantage compared to other CPAs who just focus on one thing, just do the tax preparation and just be there. So one of the books that I read since last year is this, The Power of Zero by David McKnight. And this book is forwarded by David M. Walker, the former Controller General of the United States government. So if the former Controller General of the United States government comes out and warning Americans what's going to happen, I'm going to listen to that person than the person in the street. Because he was responsible. He's an expert on that. He even wrote a book, America 2040, which I'm even planning to read. So if that person is coming to warn us what's going to happen when it comes to tax rates and stuff like that,
I'm gonna listen to him. So for me, I feel like I'm putting myself out there. I'm getting ready. I don't need to like wait for somebody to tell me what to do and what not to do. So I mean, yeah, that's just my own, observation and stuff like that. Yeah.
Good, good. Since we're on this topic, I think I might like to share and show you guys a quick video. I told you I have these videos on life insurance, Roth, taxes, and debt, and they're geared for clients. You could send them to this course and they can go through these 5-minute videos. There's debt 101, 201, 301, and 401. Same thing with taxes and then the others, but I'm going to share my screen and show you one. It'll take less than 5 minutes to go through this, but it'll give you an idea of how I use the life insurance on occasion to complement what we're doing on the Roth side. So bear with me here. I speeded it up a little bit, so we'll get through it pretty quickly.
Let's examine an original illustration and an annual statement for an actual policy owner to understand how the investment aspects work for one particular index universal life policy. In this real-life case, the 50-year-old male with a preferred rating wanted to compare adding $22,000 a year to a taxable account to funding a LIRP over 15 years, then take after-tax distributions for 25 years during retirement. Assumptions include a tax rate of 25%, an annual gross rate return of 6.9%, advisory, management, and fund expense fees of 1.5% for the taxable investment, and all projected fees and charges were included in the insurance illustration. Based on these assumptions, the LIRP performs much better than the taxable investment alternative. The 6.9% return was based on the historical average returns of many 25-year holding periods for the S&P 500 index. But a closer look at the full underlying illustration indicates there's more potential than the S&P 500 index alone. This particular product offers the S&P 500 and several other indexes. In this case, the client elected the 40% bonus for a 1% asset charge. But notice how the S&P 500 index choice is capped at 8.75% with 100% participation up to that cap for the first year of the contract. The cap and the participation rate, or par, are adjusted by the insurance company each policy year and may be higher or lower than in year one, depending on stock market volatility and the cost of index options at policy renewal times. Notice further that the par is 150% and the cap is unlimited for the indexes this owner selected. This is due to the fact that the S&P 500 index is the most used index in the market, making the options the insurance company must purchase to deliver that performance expensive. That forces the company to cap or limit the upside it can provide. These other indexes are much less expensive, enabling the insurance company to purchase enough options to provide even more than the index delivers. Remember from LIRP 101 about it being a numbers game? In this case, the policy owner would receive 150% of what the indexes selected deliver, with no cap, plus a 40% bonus on top of that. As the industry moves forward, with more indexes and higher pars and caps, the potential for attractive returns improves. Keep in mind, the rates, caps, bonuses, and fees will vary from company to company and from year to year, so it's important that somebody with significant insurance expertise be involved. Another page of the illustration indicates that these indexes have outperformed the S&P 500 over significant holding periods. A look at his first annual statement indicates that using these two alternative indexes resulted in a base return of 9.42%, with the higher participation rate, which already is higher than the S&P 500 would have given him, being capped at 8.75%. And the 40% bonus gets added on top of that, potentially turning typical returns into much better than typical. Keep in mind, the par rates and the caps used can and will change from year to year, but in this particular product, the 40% bonus is guaranteed for the life of the policy. The policy owner has the option of changing his selections on each policy anniversary. All told, in this real-life case, he is off to a great start, earning 13.2% compared to the 6.9% illustrated growth rate. And the good news is that in a negative return year, his policy earns nothing, but also loses nothing. That cannot be said with most taxable alternatives. This analysis is intended for educational purposes only and not for promoting any particular product. In 2020, the National Association of Insurance Commissioners came together to significantly limit what returns, participation rates, and bonuses could be included in life insurance illustrations used in future sales. For that reason, the illustration reviewed here would not be permitted in a new sale, even though the actual policy outperformed the illustration in year one. While it is good for the industry to limit overselling and hype, tax-conscious investors should likewise fully understand the internal workings of life insurance vehicles so as not to be misguided by overly optimistic or pessimistic illustrations of potential outcomes. Let's explore tax-free distributions next in LIRP 401.
It's just scratching the surface a little bit on some of the values that life insurance can add. Now, I would usually use life insurance when somebody's pretty much maxed out what they can do on retirement plans. But even there's a lot of things you can do in retirement plans. I mean, you could set up a defined benefit plan for somebody who's like a sole proprietor or a solo LLC where they don't have to cover other people. And you could put in, $150,000 a year into a defined benefit plan for somebody who's older, right? and you could convert that to a Roth the next year. So you'd have a taxable event for the conversion, but you'd have a tax deduction for the next year's contribution going in. So there's all kinds of things that you can do. And that's when I'm going to be there to kind of add value in reviewing cases with CPAs and their advisors. But, the diversification is a key part. So I've got clients putting in $100,000 a year into these policies. I've got people putting in $500 a month. You just kind of figure out what you want to allocate to the different tools and you set it up accordingly. And it's flexible and it has the downside protection. You get zero returns when the markets are down, but you have the upside potential that's at least as good as the stock market. Now, the other tweaks have been made to these policies. That's why I said there's 3 really good ones right now. They've guaranteed that the loan interest can't go up on you. They guaranteed some charges in it that can't be increased later on. But we want the insurance companies to be profitable enough that they're there to pay the death benefit, right? And you want the living benefits to be attractive and have some guarantees to them. So this is stuff that we'll share and learn along the way. But I can assure you, because I've done this now for 35 years, I can assure you that it makes sense in a lot of cases. If you use the wrong product or you're overselling it, you're allocating too much one way versus the other, then, those are mistakes that we want to avoid. Have you seen my calculator that compares taxes to the 40s, 50s, 60s, 70s, and 80s?
I think I have, but if you want to pop it up again, I can always use a refresher.
Nice answer. I like that. Okay, let's take a look.
Like I said, I'm here to learn, and I need to keep repeating things until they're kind of second nature,
Yeah, exactly. I agree with that 100%. Do you see my screen now with the calculator on it?
Yes.
Okay. We put this thing together where we could change the number in this box with a double click. But here's somebody that's making $100,000 in 2023. And they would be in a marginal tax bracket of 22% and effectively 13%. So their taxes would be $12,612. Easy enough to follow, right?
Mm-hmm.
Now, if we go back to 1985, $100,000 today would have been $35,000 in 1985. And if we go to the 1985 tables, 35,000 versus 100, you come over here to 35,000, they're in this 28% tax bracket and getting close to 33. So they're not at a 22% marginal. They're at 28, 33, and they go all the way up to 50. So in that year, they would have paid a certain amount of tax that, again, adjusted back to 2023 dollars. They would have paid $17,000 on that equivalent of 100 grand. So in today's dollars, their tax bill would be 17,000 versus 12,000. So they would have been paying a lot more taxes, and they're just an average earner at 100K, right? And in 75, the same thing, they would be paying $21,000 in today's dollars versus 12, 18,000 here, 21,000 here, and 25,000 in 1945. That's right after World War II, when our debt was the highest before it is today. The only other time it was over 100% of GDP, $5,900 they would have made in 1945, and that would have put them out here in a 78% tax bracket. It's crazy. And this is all adjusted for inflation. So this calculator kind of tells us what happened between 1945 and 1985 when we brought the debt down from 120% of GDP to about 40%. And according to David M. Walker, who talks about this all the time, most economists like a healthy level of debt to be between 40 and 70% of GDP. So that's what we did, and it took 45 years, but everybody's paying a lot more taxes. And if you put something in here like, let's say, 2 million. In 2023, somebody with taxable income of 2 million would pay 670,000 in taxes. But here it would be 940, 1.2 million. Out of $2 million, 1.2 would have gone to taxes. And over here in 45, 1.4 would have gone to taxes. And why is that? Because the highest tax bracket in 1945, that's only 118,000 in today's equivalent income. I mean, it would have been 118 then, but that's the equivalent of 2 million today. But that would have taken them up into this 92% tax bracket. Ronald Reagan was an actor back in 1945, and he would make movies at about $100,000 a year. And that's in 1945 dollars. So he would get to this $200,000 level with 2 movies, and he would stop making movies until the next year, because 94 cents on the dollar would go to the IRS and 6 cents on the dollar would go to California.
Mm-hmm.
He was in 100% tax bracket. So this is the eye opener. This is the kind of stuff I'm showing your clients. You have them go through these courses, and they're going to come back to you and say, Jamo, Sammy, we need to talk. Thank you for sharing this with me. What do we do about this? This is important, and it's big. So we want to set up as many tax-free income sources as we can. Do you see 3 boxes up now or no?
Okay, yes.
All right, so you have their tax return, right? You know a lot about a client by looking at their tax return. I put together this little thing here that says, let's take their assets. You don't know how much they have in IRAs. In some cases, you might know what they have in, non-deductible IRAs over the years and stuff, but you don't know what the balances are. You don't know how it's invested. You might have no clue at all what they've got in 401ks at work. So you put this thing together, and you have a taxable account where you get 1099s every year. So this is their checking and savings. They might have a brokerage account. They might have real estate. So we get a total picture here of what they've got in this taxable bucket and how much they're contributing to it. That's pretty easy for them to gather, right? And then you move over to tax deferred and you say, okay, tell me what you've got in your 401ks or 403bs or IRAs, anything that has to be taxed yet. And you see the total and you see what they're contributing. You might see if there's a match. So these things are, can all be added onto this spreadsheet. You can do it with your client. You can just have your client do it and bring it in to talk about it. You get over here to tax advantage, and this is going to be where you have your Roth accounts and if anything's going in and matching and so forth. Health savings accounts and current insurance cash values. And I put together some other things down here that are just sort of talking points that are going to help me come up with ideas, right? How far are you from retirement? What is your household income? Now, you know that probably from their tax return, but, how much is the annual spending need? How much of that are you saving? How much of it's going into this bucket? How much is going into this bucket or this bucket? So what's your annual spending need? And when you get over here to tax deferred, you should have as little as possible. Basically, you want to get as much over here as you can. But this one here, the first one, the taxable bucket, what's a reasonable or ideal level here? This is where when the old rules of thumb comes in, 3 to 6 months of your spending needs. Now, they might be making $200,000 a year of income, but their spending might be, $100,000. They might be able to save $100,000, or half of that goes to taxes, half of it goes to savings. So their spending need is let's say $100,000. So you probably only want to have about $50,000 at most in this bucket. But if somebody inherited some money or they just saved up a lot of taxable money, they might have $1 million in this bucket, right? And they only need 50,000. So how could we efficiently, move that money over here? Likewise, how could we efficiently move this money from tax deferred into tax advantaged? Do they have 401k options at work? I have Roth options on here somewhere. Yeah, employer Roth options. Do they have options at work? Maybe we should be doing that instead, because they might be at a 22% tax bracket. You can go all the way up to the top of the 24 by putting money in as Roth instead of pre-tax. And if somebody does have a lot over here, that's when life insurance usually pops up, because, if you have $1 million over here, it's not easy to just move it over there, right? You could pay the taxes on conversions. You could say, we've got a $100,000 IRA here and a $200,000 there. That 300,000 could be converted to Roth, and we could pay the taxes out of this $1 million over here, that kind of stuff. So just having this information in front of you, and this is what I'm going to do in these sessions going forward. with as many tax professionals as we can gather on each session, is we'll go through this and think it through out loud, and I'll have my ideas, and other people will have theirs. But you want to basically get this to an efficient level where you've got a fair amount of reserve, you got money you can tap in these other places as needed, but you want to get as much over here as possible so that when tax rates do go up, you're going to be looking at a number of different things over here that you can tap tax-free. You might still leave something in here, even if you could move it all out, because you're always going to have a standard deduction of some sort. If your required minimum distributions are less than the standard deduction down the road, you can tap this money tax-free and never had to pay taxes on the conversion. So these are the kind of things we want to do in terms of planning over time. Are they eligible for HSAs? Everybody on this call knows that HSAs are a triple tax, benefit type of thing. So do you even know if your clients have HSAs? Have you talked with them about it? If you do any of these conversations with your favorite clients, maybe you should be doing it with all the clients, right? So that's part of what we're talking about here. So this is a good starting point to add to a tax return. And with that, we can do all kinds of magic. And everybody's case is going to be a little bit different, just depending on how it's allocated. So we're coming up on an hour here. Don't want to steal too much time. What do you think, Sammy? Have I worn you out?
Nope, I'm on board. I'm excited to continue. I do have to drop for another call, but I appreciate the time. I will make it a point to watch your videos that I should have done before.
Okay. All
and
right.
I think we'll pick up next time, right?
Yep. Very good. That's the best answer I could hope for. Jamo, you good?
I'm good. Yeah, very powerful. I'll definitely continue joining the next sessions. Like I said, this is very informative. So, yeah.
Very good. All right. Bye-bye.